Kiwi farm rundown. Dairy's up, beef's capped, weather's still a bastard. Right, let's crack into it. Dairy's had a decent kick on the global boards. China's thrown up the barricades on beef, and the weather's reminding us once again that logistics and feed aren't background noise. They're proper risk items. Plus, there's a bit of regulatory faffing around meat exports that'll likely turn into more box ticking and delays. Let's start with dairy, and that index everyone pretends they don't obsess over. First up, global dairy trade. The index jumped 6.7% at the first sale of the month. Average price across the auction, according to Reuters via the Ag Press, came in around $3,800 per ton. Thing is, volumes were down, and when there's less product floating around, the market tends to get twitchy and move faster. What happened? Prices on dairy commodity ingredients shot up. The context. GDT remains a key signal for New Zealand's export earnings, especially on powders and base ingredients. When auction volumes drop, price swings can get sharper. What this means for Kiwi livestock farmers. If this rise isn't just a one-off spike, it'll support payout expectations and lift the mood through the season. But here's the catch. Exchange rates and the next couple of auctions can chew through that optimism pretty bloody quick. Yeah, this is when the payout calculators come back out of the drawer, briefly but noisily. What's next? Trigger to watch is the next GDT sale and how the key products move, especially powders, plus any reaction from processors and updated payout forecasts. Second, Fonterra. First quarter profit was up, earnings guidance stayed put, and they called the midpoint of their milk price forecast at $9.50 per kilo of milk solids. That's from RNZ's coverage of the quarterly results. What happened? Fonterra reported rising net profit and confirmed their seasonal outlook, including earnings ranges and that Farmgate milk price forecast midpoint. The context. Co-op results aren't read for the profit figure itself, they're read for the signals on the season, how confident the company is on prices, demand, and processing margins. What this means for Kiwi farms. Firstly, it's psychological support. When the co-op says, "We're holding the forecast," banks and suppliers find it easier to talk terms. Secondly, it hints that with favourable global prices, like after a GDT result like that, talk of higher payouts might surface again, but it's not a guarantee. What's next? Two factors matter: the next global auction results and any changes to official payout forecasts, if they come. No comments means the company's not ready to lock in the dreams in numbers just yet. Third, beef and offshore markets. Beef plus lamb. New Zealand's January trade update flagged the situation with China and their safeguard mechanism on beef imports. Key detail. Volume above quota can cop a 55% tariff, which makes pushing shipments past that threshold economically pointless while the mechanism's active. What happened? China's safeguard regime effectively limits the point of aggressively ramping exports above a certain level because of the high tariff. The context. New Zealand's heavily tied to meat exports, and China's one of the major buyers. When a tariff step appears, the business question shifts from "how do we sell more" to "how do we sell smarter?" By product mix, by contracts, by markets. What this means for Kiwi livestock farms. It's a risk to price expectations if anyone was banking on rapid volume growth into China. The bet now shifts to holding current flows and diversifying markets, rather than "let's chuck another 20% that way." At farm level, you usually don't feel it immediately, but it shows up through procurement prices and processor competition for stock. What's next? Trigger to watch. Actual export flows and how processors realign sales across markets. If we see shifts to other destinations or changes in premiums and discounts by category, that'll be the practical effect. Fourth, weather and infrastructure. strictly through the farm impact lens. Storms rolled through the North Island, and industry notes stressed that for many dairy regions the damage was localised, but the hit to roads and state highways was more noticeable. So the cows are fine, broadly speaking, but getting around and getting product moved, that's become its own mission. What happened? Storms caused localised damage, and a chunk of the problems landed on transport corridors. The context. When roads and access routes take a hammering, it hits milk collection, feed deliveries, stock movements, and on-farm services, from vets to technicians. What this means for Kiwi farms. In weeks like these, the winners are those with buffer in time and buffer in planning. Feed on hand, fuel sorted, and a clear picture of which routes are passable. The losers are those running just-in-time operations. One missed delivery and the whole chain starts unravelling. What's next? Trigger. Restoration of key road sections and weather stability. It hasn't become a systemic story yet, but these episodes usually force farms to revisit their Plan B on logistics. And to complete the picture, the South Island. Dairy NZ, via media comments, noted the summer's been unusually wet, overcast and stormy. Milk production in some zones ran above last year, but there's risk on the horizon around winter feed and its quality and harvesting. What happened? Productivity's holding, but weather conditions are complicating pasture management and the feed plan. The context. Too wet isn't a comfortable version of not a drought. It's pressure on pastures, windows for harvesting, and sometimes on animal health and hoof condition. What this means for farms. More attention to silage and haylage quality and planning winter now, not when the calendar suddenly reminds you. What's next? Trigger. How the next chunk of season plays out and what the actual windows look like for feed making. Fifth, meat export regulatory faff. MPI ran a consultation on draft animal products notices covering specified meat for export with official assurance and official assessors. The public consultation page noted the deadline was extended to the 23rd of January 2026. What happened? Consultation on updated rules and procedures tied to export official assurance and assessment. The context. These changes usually don't look like news of the day, but in practice they show up in inspections, paperwork, compliance costs and process speed, especially if verification requirements shift. What this means for the sector and farms. Farmers feel this indirectly through processors and exporters. If compliance gets pricier or slower, margins and procurement policy can adjust. The actual effect depends on the final version of the documents, which isn't in this consultation notice. What's next? MPI will process feedback and publish final versions and clarifications. The public consultation page doesn't list specific dates for final implementation, so honestly, it's unknown. Right, if we're pulling this into one thought, on dairy, the offshore markets perked up noticeably, and that's a good signal. But confirmation will only come from the next auctions and official forecasts. On meat, the opposite. Limits in numbers have appeared that won't let you dream about volume growth without staring down tariffs. And on the ground, as usual, it all comes back to feed, roads, and weather predictability. When infrastructure's shaky, even good prices feel worse. Cheers, and if this was useful, hit subscribe and give it a like. Have a good one.